In January, my January investment letter, I raised my targets for the equity market. So I am currently at 7,000 as a target for the S&P. I'm up to 23,000 on the NASDAQ, had been 20,000. My Dow target is now 55,000, and my Russell 2000 target is 3,300. That's probably the one that's the hardest for people to swallow. From here, that's like a 65% move. So, or not from here, but if we correct back down to say 2000, which is about where it looks like the Russell's headed here this week. So, 65% move, and I think that move happens this year. That's a obviously very historic move, and even the S&P from might correct back down to 5150, let's say, which isn't very far from here. To my target, it's like a 35% move. So there's a lot of upside still ahead, and yet, as you said, there's I think a lot of nervousness in the market right now. People looking for corrections and thinking this thing is pretty extended and shouldn't go much higher, if at all. I'm not in that camp. Obviously, I think this thing has legs. It surprised people all year. So all those people kind of talking like this thing's not done well. It's done well all year, and it's done well recently. So I think its perception is not reality. And I continue to say, melt up ahead. We're in a melt up, and that melt up is just going to get steeper from here.
Yeah. So what sort of caused you to upgrade your price targets? Is there any catalysts behind it?
Yeah, basically, it still looks like when I stepped back and looked at the indexes, it looked like there was more room upside from where I had a target 6,000 to 7,000 for the S&P, so it really wasn't a big change. Although then my convictions had grown that we were going to see the upper end of that band. For the Russell, which is the farthest from its target, it just looks to me like it is going to break out once it gets going here. I think you're going to see it really gain some speed and take leadership from some of the bigger cap stocks. So it was more seeing that this thing is reaching, meeting its reaching its fruition in terms of gaining traction, and fought through a lot of the skepticism, and now seems to me clear sailing ahead. You're going to have 2 and 3 and 4% corrections along the way, or pullbacks along the way. They can happen anytime. So I continue to say I think the bond market's in good shape. I don't expect, can always happen because we're at 460 on the 10-year, can always see 5%, but I don't expect that. I think we're nearing the end of this backup in rates. We really, if you go back and look, we've really had a counter trend move in rates back up throughout this whole 5-month period this year. Started at the beginning of the year. It has been, choppy upward since. We came down from 5 to 380 on the 10-year last year, the fourth quarter. And what we've done here is gone and retraced a good portion of that, but not all of it. We've gone from 380 back to got up to 473, I think, in April, and we're at 462 now. I'm still saying I expect a sub 3% move in rates this summer into the fall. So that'd be a nice move in bonds. And if you get that, and I also expect the weak dollar, you get those things happening, and I think you're going to see the stock market do very well.
Okay, so in your opinion, we shouldn't be worrying about inflation in the near term, at least.
Yeah, I mean, the Fed's worrying about it. We had an uptick in rates and inflation in the first quarter. But when you look underneath the surface, the PCE deflator is 2.7. We're moving towards that 2% target. We came all the way down from much higher. It's just not coming down quickly anymore. The easy part of the move has happened. Now it's more grudging, and you get some, it's kind of a sawtooth thing. You get some back up, and then it comes down. but the economy is not in great shape. I mean, you still have people believing it's, not, we're not going to see a recession, and that it's stronger than expected. But really, underneath the surface, consumers starting to run into resistance here. Their consumer confidence has been off the last couple of months. Not necessarily the conference board number that came out today, I guess, was up an uptick. But basically, consumer confidence, Michigan consumer confidence is showing indications of consumer rolling over, being concerned. You see delinquencies in credit that are picking up speed. I just think we're at a kind of a level where you can't expect the consumer to carry this thing for much longer. We're not imminently ready to roll over in the economy, but we're also not super strong and going to be pushing inflation fires. So I think you're in that period. I talked about this many months ago, that I thought the last stage of the equity market would be partially driven by a kind of a porridge just right type of a mentality, where it's not too hot, not too cold. We're not heading for a recession, but we're not also seeing inflation fires roaring ahead. So I think we're in that kind of sweet spot. It's not a glorious thing, but it keeps the market moving. And I think there's still a lot of skepticism among investors. Retail investors have pulled back. A recent Schwab survey showed that they're concerned, and the institutions continue to kind of fight this thing. As always, the momentum has been pretty good here this year, so in the market. So, they have raised their targets to mid fives, 5,500. You're not far away from that. But I think they all feel like there's a lot of problems that could surface at any time. So the skepticism there, wall of worry is there, and that's what fuels an upside.
Yeah, thanks for running us through that. So, are you seeing this disconnect? It seems like there's sort of and people have been talking about this for years. There's quite a big disconnect between the economy and the markets. Do you think that's something that's going to continue, or do you think once, as you said, the economy rolls over, potentially in 6, 12 months, or whenever it happens, that we are going to see a market correction from there?
Yeah, I don't see a big disconnect. Frankly, this last 18-month move from 20-month move from October of 2022. Initially, it started as happens when you come out of a bear market or come out of a sort of a semi-recession. Earnings were down, and we went through that period where earnings were, they kind of had to lower expectations, and then earnings kind of did okay versus expectations. But of late, you're seeing signs that earnings are picking up speed. So I don't think there's really a disconnect. The U.S. Business community U.S. corporations have done a good job of basically keeping earnings going while they face some headwinds in the economy. And now there's a feeling that the earnings are actually on an upswing. So I think the market's acting rather rationally. What was irrational was people got caught up in the scenario. Me, I have a global bust forecast out there, but it's not yet. And I think people started worrying about those kind of concerns way prematurely. And so 2022 happened with the Fed tightening, and they just never got out of that kind of gloom and doom viewpoint. And of course, the tapes dragged them up kicking and screaming. They are driven by momentum, and the momentum was going against them. They finally had to kind of grudgingly get on board, but they're not ebullient by any means.
Do you think there's still investors out there? Because from my perspective, it seems like things are quite bullish. You're not seeing much bearish sentiment. Are you seeing the same? Are you seeing the opposite?
No, that's what I just said. I think the institutional investor is not bullish. He's not a roaring bear, but he's a raving bear. But he's looking for bigger pullbacks than I think he's going to get. And the retail investor, like I said, the Schwab survey this week they are very nervous here. So I don't think, sentiment surveys may tell you something different, but when I look at investors and where they are, they're not confident. They are there because the market is there. They're forced because of the tape to kind of say, well, I don't want to fight this too much or I'm missing out. But they're there in a nervous way. And you see that whenever we get a correction. We had one in April. As soon as you get a 2 or 3% pullback or even a 1% pullback, you have people coming out of the woodwork talking about a much bigger correction. They I told you it's coming, here it comes, and so I don't think there's any conviction to the upside. What I've seen is when we went to new highs, yes, people got more bullish, the institutions got more bullish, but with very little conviction, which means then the only thing keeping them up there is the momentum of the tape. And then when you get the pullbacks, the momentum reverses, they're quickly back to seeing the downside. That's not bullishness.